Hi everyone and welcome. I'm Steve Johnson, Chief Investment Officer here at Forager Funds. This is our first video recorded webinar, so you'll have to forgive us if there are a few glitches along the way, and hope you enjoy it and give us some feedback on the format. Before we kick things off, just a quick disclaimer. Anything you see in today's webinar is general advice only. Does not take into account your personal circumstances, and you should seek professional advice where necessary. We're going to talk today about why our portfolios are very close to fully invested. In fact, the closest we've been to 100% invested since we started the funds. In the Australian funds case 10 or so years ago. It might seem odd with markets hitting all-time highs at the moment and a lot of people very worried about a downturn. We've been finding plenty of opportunities out there, and we'll explain some of the reasons why. It's been a very difficult decade for value investing. We've been talking about this a lot, and you're probably sick of hearing of it, and you're probably sick of seeing the impact on your portfolios as well. Despite some signs of upturns in the past couple of months, we have continued that underperformance of the past 10 years, really over the past 12 months as well. There are signs, and there's a lot of talk out there about the environment for value stocks improving. We've seen a little bit, but we're not expecting a lot of that to happen in future. What has been different over the past year is that there's another sector that started to underperform, and that is the cyclical stocks out there in the market. You can see on this chart, this is USA only, but it's comparing cyclical sectors to what are defined as defensive sectors over the past year. If you remember the big sell-off of December last year, the cyclical stocks haven't really recovered, whereas defensive stocks are through the roof. We're going to talk a little bit about why that is the case today and what sort of opportunities it is throwing up. Most importantly for me though, there are lots of good quality businesses that I would put in that cyclical category. And the big difference that it's made to our portfolios is it's allowed us to fill up what have historically been some deep value portfolios with some much better quality businesses. I'm going to talk about a few of them today. And first up, we're going to focus on the international fund with my international fund colleagues, Gareth and Harvey. Gareth Brown on my right and Harvey Magotti. Harvey, we'll come to you first. You joined us about 6 months ago, and you've been finding lots of opportunities out there in the world, and particularly, I would say, in this space. You like better quality businesses. There've been a few of them available in the cyclical space. First of all, what's the backdrop here? I mean, why are people not that optimistic about these stocks?
Yeah, I think we have to rewind back to what happened last year. In the back half, economic data started slowing. The China-US trade war started escalating, and the market obviously wobbled. We had a huge drawdown in Q4, particularly. A lot of people might have seen the effect of that in their own portfolios. But on the back of that, there was quite a strong monetary push by the various central banks and governments around the world. Rates went right back down, and that kind of just helped drive people back into the market this year, partially. Data also at the same time stopped getting worse, towards kind of Q2 of this year. That drove a big rotation back into the defensive sectors, as you say, the bond proxies, so to speak, and the higher quality businesses, while a lot of the cyclical names were kind of left behind. So, around the time that I joined here, there was a ton of opportunities that I saw in very high quality names that just weren't pricing in, I think, the right valuation or outlook given the market backdrop. And so that's the kind of pond I've been fishing in, so to speak.
Yeah, so I guess we've had that throughout the year. Although stock markets have been up because interest rates are down, we still had this trade war going on, and it's lasted the whole year. We've had economic data that's been generally pretty weak. Have you seen that change in the last few months? Are there signs that things are going to be as bad as people had feared, or worse as we look into the next year?
Yeah, I mean, it's tough to say because you have this big binary event with the China-US trade war. Overnight, Trump just said that he wouldn't mind pushing back the trade deal to after the next election. That's obviously not been expected. Market sold off a little bit on the back of that. So there is a bit of a fork in the road, so to speak, that things can go either way. However, all other things being equal, we are seeing a bottoming out of certain data points. Manufacturing indicators around the world have actually moved positive after 18 plus months of declines over the, since late 2017, let's call it, when it peaked. So there are a bit more positive signs ahead. 2020 could shape up to be a pretty decent cyclical recovery year if you just get this damn thing signed and these guys stop fighting. So there are reasons to be positive, but even in the absence of this happening, there are certain names that just continue to grow and are misunderstood. You know, they're seen as low-quality cyclical businesses, but actually they're secular growth companies.
Yeah. It's been my view that we're in a world where tepid is probably the best way to describe it, and interest rates and monetary policy have been pushed so hard that everyone, I think, gets very fearful about significant downturns. They're probably not going to be as bad as people think. And on the other side, the chances of rapid economic growth, given the amount of leverage in the system and some of the productivity issues that are out there, is very limited. So what we've been looking for and finding, I think, are some of these businesses where we think there's some structural growth within an industry. And one of those that you've been writing about is Zebra Technologies. It's in one of our recent quarterly reports. Can you just give us a bit more information about that business?
Yes. So as Steve said, if anyone wants to get a bit more background, just boot up the September quarterly, and there's a page on the company itself. Essentially, they're a leader in asset capture devices. In layman's terms. So, if we have a slide up here, but you can see their products. They look pretty basic, nothing too exciting, right? Little mobile computers, barcode scanners, etc. But when you scratch beneath the surface, you see this is a company that is helping businesses gain visibility into inventories, into the products they serve. And it's really a key component of e-commerce growth. And that's what I kind of like about it. The market misunderstands the business. They have a lot of retail exposure. And, the playbook over the last few years has been like anything with bricks and mortar retail, let's avoid it. Forget that, can't touch it. That is not the case with these guys. These guys keep growing within that category. And why? Because e-commerce, on-time delivery, and all of these things that we are coming to expect as consumers are becoming more important. So the Amazons of the world are obviously, more leaders in that. But all of the older businesses, the Walmarts, the Targets of the world, they need to adapt to this new environment, and they are adapting to this new environment in order to survive.
The ones that are doing it well are getting connected.
That's right.
You can walk into JB Hi-Fi now and talk to an assistant, and they pull out the PDA there and start telling you what's in inventory, or if they don't have it in inventory, what store down the road might have it. And they're able to do that right there while they're talking to you, rather than having to go off and tap into some computer or to go and look out.
That's right.
Out the back.
Yeah, it's one of those businesses you don't notice much until you've heard about it and own it, and then you see it everywhere. And it's been interesting when I look back on it. I think that retail experience has become a lot more seamless in good retailers, and you really notice it in. I was in a David Jones recently. It's still got very, very old technology at the counter, and you actually notice how bad the experience is when you go back to the old types of scanners and things.
It's interesting. I went to a Kohl's recently, and I was looking for Beyond Burgers to try them as part of research into non-meat based food, and they didn't have any on the shelf, so the guy actually booted it up on his terminal, and he's like, "Oh, we have actually two back in the back shelf room," and he went and got them. Like in the old days, you'd have 2 times the floor staff, and they'd be running around and checking. They wouldn't even really know where things are, and this tells you exactly, okay, the shelf is empty, you got to restock, or you're missing this kind of shirt on the racks at clothing store. Put it back on, or send it from the central location. It's a beautiful little business, and the good part about it is it's not just exposed to retail, which is a sector that's struggling. It's exposed to e-commerce, transport, logistics, and everything else. And if you think about the number of packages being delivered now versus 5 years ago, and you think about where we're heading, I mean, people order a little piece of makeup now, and it comes in a box. That box has a barcode label on it. It's just becoming more and more important to track these things, and there's huge secular drivers. That are helping this company. Its valuation's cheap. We just, we like it.
Yeah, it's interesting here. I think the visible part of the business, the perception is bricks and mortar retail, and therefore people worried about it. But as you can see on the chart here, there's a huge portion of this business that we don't really interact with as much in our day-to-day lives, where there's more and more technology going into getting this stuff into your house on time, and the right product and the right person.
Yeah. Well, they just had their biggest contract win in history with the U.S. Postal Service. 300,000 of their mobile computing units will be deployed across, all these delivery fleets that the U.S. Postal Service has. So even kind of the more sleepy, I'd say, companies, the kind of government-run institutions are realizing they have to adapt and to survive.
You also had an interesting table in the quarterly report. This company's got very high market shares, and its main competitor in most of those spaces is Honeywell, or in a significant portion of its business. You're competing there with a giant conglomerate that has a lot of different businesses. I'm sure this is an important part of it, but I like that focus of this business on one particular area.
Yeah. Look, as do I. I mean, we also love Sony, and they have 4 different types of businesses there. And we see the company's fundamental undervalue, but there is something really special about companies that focus on just one thing and do that one thing well. They're outspending the nearest competitor, Honeywell, which you mentioned, on R&D by a ratio of 3 to 1. And why is that? It's because they can focus on just this one thing. They're not competing for capital across other divisions, and it just it's a huge benefit to be focused on one whole thing.
Yep. Share price is up quite a bit since our first purchase, probably 20% or so over the past few months on the back of some good results. And we're going to need more growth in this business to justify today's price and for us to do well from here, but we're pretty confident about that happening. Gareth, you and I were looking at another cyclical sector, the auto space, prior to Harvey's arrival. How would you classify that particular sector in terms of cyclicality, or I guess this opportunity around people being very pessimistic about the global economy?
So I think the auto sector, both directly and indirectly, has a lot of businesses that I would categorize as high quality cyclicals. We bought a few of them last year. So Linamar and Lear, very directly tied to the global automotive industry. They've done everything right. I think they're operationally doing well. They're making profits. They're gaining market share, but they are running into a strong headwind, particularly out of China. And so that has impacted them. We haven't been making money out of that yet, but we're well placed when the tide turns. I'd also put Auto Trader in the UK into this bucket. Obviously, it's a very high quality business that maybe doesn't really belong, but we only got the opportunity there because of Brexit and because of concerns around the automotive industry. We've sort of covered that well in the past, so I won't go into great detail here. We've done well out of it.
I think as a sector as well, there are questions about what's cyclical here and what's structural. And I think those questions are legitimate. We've debated them a lot and thought about them a lot, but I think what we want to see is these businesses continuing to gain market share. And I think in that case, even if demand just levels off rather than shrinks at some point, you should do pretty well owning these.
I think that's our base case at the least for both Linamar and Lear. On the bear side, they are trading, fairly cheap next to the value of their assets. So even in a declining market, they can sort of recycle those assets into cash over time. So we think we're well placed there.
And there's another UK company alongside Auto Trader that we've added to the portfolio recently. We haven't written a lot about this one because it's fairly early days and we've been trying to build the position up, but good early signs here as well, auto exposed, but in that category of really good business.
Yeah, so the business is Motorpoint, which is a used car dealership in the UK. And this is not, it's traditionally, used car dealerships are considered a competitive, very tough industry, a lot of pricing pressure. So that's on one side, that's what you expect to see when you open an annual report. But what you actually see is a business that's generating very fine financial metrics. And so I'm always interested in that divergence, what I expect to see and what actually comes out the other end. So Motorpoint has sat on our watch list for a couple of years now since it came to market. We got the opportunity to buy it earlier in the year.
We've got a picture, if Alice can just get it up on the screen, of one of their dealerships. When you first turn up to me and you say dealership, I think a whole heap of cars sitting in a parking lot, very capital intensive business, historically been a low margin business and personally somewhere that I hate going because of the whole haggle that goes on. Yeah. And what's different about Motorpoint from the traditional auto?
Okay, so they operate currently 12 of these sort of large plate side, large dealerships, typically 500 or more individual car slots on each site. They're soon opening their 13th and they've got a couple of more sites in the bag ready to go too. They're focused here on near new vehicles, so less than 2 years old, less than 15,000 miles on the clock. And they do it with a fixed sticker price. So there's no negotiation, no haggling. We've seen that model work very well, particularly in the US with CarMax.
Just quickly on that model, I think it is working really well because there's another aspect of play here, and that's the rise of online price discovery for people. So we've talked a lot about this with both Auto Trader and car sales, but people used to go to 6 different dealerships and argue about price and try and find the right car. Now they've typically done all their research online. They know what they want. They know what the right price for it is, and they're walking into a dealer knowing all of that. So I think this model of we're not here to haggle, there's a sticker on the car, this is the price, it works really well, I think, in an environment where the customer's very well informed.
Yeah, I also think it was an underserved market, the people that just didn't want to haggle in the first place. It wasn't an option 5 years or 15 years ago to have that. But don't be confused there. The cars that they're selling at very good prices versus the competition. So it's no haggle, but it's a good price. And how can they do that better than the competition? So they sell cars quicker. They sit on the lot for less than 40 days on average versus north of 60 for the competition. So they can sell it on a low gross margin, but actually make more profit from that slot over the course of a year. They're independent, so they're not beholden to Volkswagen or Toyota or whoever else is the car maker. They can buy what's cheap, and they can buy what's in demand and do it for the advantage of the customer. And sourcing is the other key piece here. They buy a lot of near new cars from, for example, short-term hire companies, the Avises of the world. If you have 1,000 Ford Focuses, for example, to sell, there's not a lot of places you can call up and get it done in one deal. They can buy one model of car, even in one color, and they can move it through the network really quickly, and they get it much cheaper as a result, and they pass those savings on.
We had the slide up on the screen there, but this business is 50, 60, 70% return on equity, which is extraordinary for any company. And we think there's more potential. We were, I think, originally buying this stock at 10 or 11 times earnings, which is a no growth price to be paying for a business. And we think there are growth prospects here, both in the existing network, but also ability to grow. And that's probably what's changed in recent months, is they have announced a number of new sites to roll this out to, and we think that will perform very well. We will get you gentlemen back later in the presentation for Q&A, but I just wanted to reiterate, particularly in this international fund, it's been a lot of change over the past 6 months. We've deployed a lot of cash, and it's actually a pretty long list. We've talked about a couple of specific examples of stocks today, but it is a pretty long list of good quality businesses that have made their way into that portfolio. And Gareth, you and I have been around it for a long time. I think that mix that we've got at the moment of some liquidity, some really small illiquid things that are performing very, very well, and some better quality businesses alongside the traditional value stuff that we've been doing, as that portfolio set up very nicely at the moment. We will catch you guys in 10 or 20 minutes or so. Just while we're changing over the team, Alex Luckman's got a quick poll that she'd like you to fill out, and we'll be back in 20 or 30 seconds. So there you go. I sometimes worry we do too much on the stock specific side of things, particularly on the international side of the business, whether you're interested in those companies or not, but it seems like a lot of people like seeing plenty of that and want to see more. Thanks for that. So I'm joined now by Alex Shevelev on my right and Jeffrey Tsay. Welcome, gentlemen.
Hi, Steve. Hi, everyone.
Hi. Both of you work on the Australian funds. Alex, to you first. We've just spent a lot of time talking about cyclical businesses and better quality ones and opportunities that's been creating, particularly internationally for us. Has that dynamic been at play in the Australian market as well?
Less so, Steve. And a lot of the issues that Harvey's drawn attention to, the trade war that we've seen, hasn't impacted us to quite the same amount. But we have seen some issues pop up around variability in earnings and just general disappointment. And that's thrown up quite a lot of opportunities here as well.
And there has been quite a bit of concern here in Australia about the general economic backdrop. We've seen the RBA cut rates a number of times. Perhaps less businesses listed on stock exchange though, that are as sensitive to that as we see in some of these global markets where they're plugged into supply chains. Jeffrey, what are some of the sectors that you think have been turning up opportunities that might be related to this thematic?
Yeah, sure. So maybe similarly to the international fund, we've been finding opportunities in the auto and auto-related sectors. So it's been in the headlines for quite a while, but new car sales have declined month on month for the past 19 months. And there was a lot of pessimism in the sector, particularly starting around the fourth quarter of calendar year 2018. So we've probably added about 20% of the portfolio to stocks related to the auto sector, but maybe not directly tied to new car sales.
Just on that, we've got the slide here up on the screen around new car sales. It's been very, very recessionary in that space. I mean, we haven't seen the wider economy go into a recession, but you're seeing numbers here that are minus 10% month on month. We've just started cycling what were bad months already the previous years and still posting some pretty awful numbers. So I guess in that space in particular, it hasn't just been perception, it's been reality in terms of car sales. Why have you picked some of the stocks that you've picked in that type of environment?
Yeah, sure. So the three stocks that we've, maybe just to call out three stocks that we've added in the auto-related sector, car sales, Smart Group and SG Fleet, maybe weren't directly tied to new car sales. And there was, we thought from our research, there was a decent chance that the earnings and the revenues could be quite resilient through a downturn. That was very much a theory, but for those businesses, the long-term picture also looked very favorable and the valuation looked attractive at the time. So maybe for a brief overview, car sales is the dominant online car classifieds portal in Australia. Smart Group is one of the two major salary packaging administrators, which also administers novated leased vehicles, mainly for charities and hospitals. And SG Fleet is a fleet management company.
Yeah, I think even a business like car sales, which I think most people recognise as a world-class business, share price was probably 17 down to 12 at one point as all of this bad data started coming through. We're more than a year into that now. What are you seeing in terms of that resilience that you hope these businesses would show?
Yeah, so the hope for the resilience around car sales was really just around the pricing power, the latent pricing power. We did a bunch of on-the-ground research and talked to a bunch of used car dealers, and we came to the view that there was no real viable alternative. You either list your car in car sales or you probably don't sell the car very quickly. So we felt the company had a lot of pricing power that would continue in the long term. And while we might have been wrong in the short term, which we thought there was a decent chance we weren't, the long-term picture looked favorable. And added to that, car sales was exposed to used cars rather than new cars, which was more resilient. And also we had a couple of fast-growing international businesses, so a little bit more of a diversified revenue mix.
And on the other two stocks, what was the thesis there?
Sure. So for Smart Group, it's a salary packaging administrator. The end markets it serves are primarily public hospitals and charities. The interesting thing about novated leases is there's some tendency to roll over your lease when you get to the end of the 3 years if you don't have the money in the bank to buy the vehicle outright. So there would be some degree of recurrence in that revenue stream. Maybe not as maybe there would be some reduction in yield, which we saw. I guess the long-term picture for Smart Group is really just the employment growth in the health and charity sectors, and really its market position operating in a near duopoly with Macmillan Shakespeare in its salary packaging administration. It's a very difficult service provided to dislodge. And just on SG Fleet, maybe just briefly. So SG Fleet is a fleet management business. It's, I guess, would be maybe related to new car sales, but the overall thesis there was that the fleet size, I guess, most of the companies that they serve are in the public sector or related to the public sector, like utilities and infrastructure sectors. So there would be some requirement for vehicle fleet, even though new car sales might fall, the overall fleet size might not change.
Yeah, they're two businesses that are at an interesting point in their life cycle, I think, because they're both consolidators in their industry, and you've seen a very significant percentage of the consolidation that's going to happen, maybe more in the fleet side than in the salary packaging side, but you've seen a lot of value created by doing lots of small acquisitions and rolling them up into a bigger entity, and it's largely over. So I think the investors that really like to buy rapidly growing businesses are probably not that interested in some of these companies anymore, and yet they're not trading at prices that maybe a traditional value investor would say single-digit multiple of earnings. Or price to asset discounts. So I think it's an interesting time in their lives at the moment where you're picking up a really healthy yield on some of these businesses, and we still think they'll be able to eke out some modest growth over time as the businesses grow. Alex, it's been a better start to the year here in Australia in the traditional value space as well, after a fairly horrible couple of years prior. What's been driving the returns there in the Australian fund?
So we had a reasonable reporting season in August. One of the companies that came out of that was with quite a positive result, CSG Group, the ticker's CSV. Now, the company was 13 cents in June, and the share price is now over 30 cents. We've had a bid for that company come through from Japanese giant Fuji Xerox. It's a business that offers printers and technology to small and medium customers on monthly plans, reasonably flexible, and they will finance the equipment. The company struggled for quite a while. They had a new management team come into the business, and they've done a lot of work to try to improve how that business was operating. And they were succeeding, it looked like. It was the early stages of a turnaround, and then we received this bid from Fuji Xerox. Now, interestingly, Fuji Xerox is actually not the print manufacturer whose equipment they sell into the market. Those are Canon and Konica Minolta machines that they put out there. If I was Canon and I was Konica Minolta, I'd be quite worried about losing that amount of revenue, because it's quite high margin revenue for those manufacturers. And there's actually plenty of reasons outside of that to bid for CSG again from those groups. So we actually added to our position after the takeover from Fuji Xerox was announced.
Yeah, it's an interesting situation there now with, I think, a fairly, extremely likely bid if nothing else comes along. You've got significant shareholder support, you've got board support, you've got a well-funded bidder that is likely to go through with the deal, and the stock price reflects that. It's trading very close to the bid price, but we think there's probably more potential than the market sees at the moment for an alternate bid. So fingers crossed. It's been a problematic investment for us for a long time, so it's certainly a welcome bid in terms of the timing of it coming along. And I think the point of recovery that business was at, we were seeing signs of improvement there, but this probably pays us for a few years of that recovery now at today's price.
And what other traditional value stocks have been added to the portfolio lately?
So we've added WPP, which is the Australian offshoot of a very large UK-listed advertising group. So we're talking about things like your typical Mad Men style creative agencies. You've got some media buying businesses in there. And like the car sales graph that you saw earlier, advertising's really struggled in Australia, and WPP has had some issues with very particular retail-focused businesses as well. However, we think that business has quite a high market share domestically. It's plugged into a lot of very specific sectors, and it is really addressing those niche concerns that they've had over the last little while that's really dragged profitability down. So it's one that should weather the storm.
Something I've been harping on about a lot, both with you and in our newsletters as well, is, if these stocks are really worth what we think they're worth, then they should be paying us cash over time to justify that purchase price. And it's been one of our issues in the portfolio that there hasn't been enough of that happening. So the question with WPP is, are we going to actually see that profit come back to us as shareholders? And particularly in this case, they've sold a significant part of their business for a large amount of money, and what happens to that cash is going to be a big driver of the end result here. What do you think about the likelihood of cash coming out?
So we've been talking to management, we've been talking to the board of this company, and just really shouting, show me the money. And we think we're going to get, and we hope to receive, a reasonable proportion of the current market cap back. On our numbers, it's possible that a quarter of the current market cap can come back to shareholders as a fully franked dividend from that business. Now, the stock actually still trades on 6 times earnings and an ongoing dividend yield of 12%. So even if that happens to a lesser extent than we imagine, we should still see pretty healthy cash out of the business to us over time.
Be good to see, and hopefully we'll see more of that across the portfolio as well. It's certainly been a more encouraging start to the year, and some big fat dividends from quite a few of the companies that we own. So similar theme really in the Australian fund. We are much closer to fully invested than we have been for a long time. A combination of better quality ideas coming into the portfolio and some traditional value stocks as well. Just wrapping things up before we go to Q&A, you can see on this slide that cash weighting that I've been talking about for both the Australian fund and the international fund down to 5 and 3%. When we sent out the invitation for this webinar and titled it The Case for Being Fully Invested, I copped a bit of grief back on email straight away. I know a lot of people are nervous with stock markets hitting record highs, very cheap money, quantitative easing, all the things that we've been worried about for years out there, and think that being fully invested in times like this is a very dangerous thing. I'm really happy with these portfolios that we've put together, and I think we're operating in a world now where returns on all asset classes are very low. Hopefully you've seen from today's presentation, there are pockets of opportunities out there, types of businesses that haven't participated in this rally. And in the case of some of the new things we've been adding, some very high quality businesses amongst that mix. I've got a very strong view that we should be mostly invested most of the time. You pay us fees to invest your money in equity markets. And I still think as we sit here today, relative to most other asset classes, the returns on offer from equities are reasonably prospective. And we're particularly optimistic about the value that we can add in our little corner of the world. We're going to move on to Q&A now. And while we just bring the rest of the team back in, Alex has got another poll that she'd like you to fill out.
I think we need to zoom out a bit, Alex.
I'll do it.
It's fun to watch live. Oh wow.
Looks like the only thing clear out of that is that no one wants to hear from you, Harvey. 2% votes on that front. We're thinking of doing a webinar over Christmas. A few of us are going to be around the office, and I know it's a time when a lot of people have had enough of their families and might be interested in a slightly longer format webinar where we do talk about a few either stocks that we own or maybe some that you can present live as options for us in the webinar, and we'll run through our process and how we might look at a new stock like that. So we are back for Q&A here. There's a panel on your screen where you can type the questions straight in, and I will just get them up here on my phone and we can work through them. So question here, Harvey, who are the main competitors to Zebra? We talked about Honeywell a little bit there. Maybe, I guess, where that company competes and who else in different parts of the business.
It's really just Honeywell. I mean, that's the big one that competes across most of the segments that Zebra's in. There are a few smaller guys, based out of Japan and Cognix and so forth that play in pockets, but no one that does the whole spectrum of products that Zebra does. So it's almost a two-player market with a tail of other smaller companies doing, a variety of things.
And what are the barriers to stopping new entrants into that space? It's obviously appealing, and I think we've actually seen a few people have a crack at it over the years.
We have,
successfully.
Yeah, I think the fact that the company spends a significant amount of R&D, to develop new products constantly, and you have a 4-year refresh cycle on a lot of these things. It just becomes difficult for someone to make a good case for allocating so much capital and so much spending to try to break into a market that isn't that big in absolute dollar terms. It is almost the perfect market for a handful of players, and that's the nice part. I think if the addressable market was 10 times the size, it would be a bigger risk than it is right now. Yeah,
there's a good question here about Enero, Aussie fund guys. You seem to be selling chunks of Enero despite your positive comment in monthly quarterly reports on its forward outlook. Have you decided that's as good as it gets, or are you simply trimming due to position size? I say that's a good question because we've been discussing it a lot in the office. If we look back over the past few years, we've left a lot of money on the table with companies like Jumbo Interactive and Service Stream that have gone on to better and better things after we've sold it. What's the story with Enero at current prices?
So Enero is a very large position in the portfolio and has been quite large as we've been selling and even subsequent to our most recent selling. It is probably in a slightly different bucket to the others. This is mostly a bums on seats type business where you hire a person, that person does some work for you, and you get some certain margin out of that person. We have got some pretty good results there over the last little while. There is potentially still more on the table, but we're trimming our position at the moment, given how large a position it has become in the fund.
Yeah, and we'll constantly reassess this. I think we're about 6.5% at current holdings, and I'm reasonably comfortable with that as a weighting. It's still a very big position and a big investment for us. I still think that business is going to grow over time, but there's some of that growth now priced in to today's price. And there's probably even, I would say, a couple of well-managed acquisitions priced in today, because it is hard to grow these businesses really rapidly organically. So that we've seen a couple of good acquisitions in recent years really contribute to that growth. And it's always a more dangerous way to grow a business than organically. Question here about the general outlook. Both funds are fully invested, yet there are currently heightened risks for an Australian and/or global recession or some other external shock. Can you please provide insight in your process for evaluating the resilience of each stock to a severe economic downturn? How do you stress test these stocks? Maybe you, Harvey, again, on some of the stuff that we've done globally around that economic sensitivity and how we think about that.
Yeah, I mean, you have to look at what the company's done in previous cycles and clearly model the downside scenario and how bad it would be. You know, are we talking about a 2008-9 global recession where everything's frozen, or a regular recession that you see? And we've had a bunch of them in the industrial space, you know, 2014, 15, 16, oil collapse kind of shocked a big part of the ecosystem there. So I think, you know, history is a good metric usually of what the downside case could look like. And I just think you have to do a lot of work on where you are in the cycle and what you're paying. You know, are you paying a high multiple on high earnings? You know, that's obviously risky. Or paying low multiple on low earnings, trough earnings, so to speak, with things having potential to inflect. That's obviously where you want to be picking these things.
Sometimes a low multiple on high earnings is a very dangerous place as well.
That too, yeah.
Gareth, just on the auto space, I mean, stress testing that for history and downturns?
The concept of owning the strongest hand in the industry, I think, is really important here. We want businesses that, I'm not saying that if you have an economic downturn, you're not going to suffer, but they will pick up share. They will be better placed when you get through the trough. So I think it's, you know, I don't have any better ability than anyone else to time these things, but having the strong hand that's going to come out of it looking stronger than anyone else is key.
I do think as well there's the financial crisis of 08-9 is very fresh in everyone's memories. And I think when people think about stress testing the downside, they go back and stress test that scenario, which is not a bad thing to do. I think it's worth understanding how these businesses will perform in that type of environment. You also need to question how likely that type of an environment is. And it was a particularly severe, nasty recession. And you know, it's something that Linda Hassenfratz, I've heard her, the CEO of Linamar, be asked this question a lot. And she said, well, just go back to 2009 and look at it, but don't forget how severe that was in the context of historical corrections. And you know, what we've seen over the 10 years since is a number of smaller, shallower recessions. And I actually think that's probably a more likely environment for us to be in future than the massive, severe correction. Scale of 1 to 10, 1 being cheap and excellent future potential, 10 being expensive and low future returns. How would you rate the current portfolios?
I mean, starting on the Aussie side, I think there's quite a few stocks there. A lot of the new stuff that we've added and some of the stuff that we have had historically in that portfolio that's performing a little bit better than it had. So yeah, quite excited about the portfolio there.
4. I find that scale a bit hard to work with. I want 10 to be the outstanding opportunities. But if 1's the outstanding opportunities, then a 4. I think we're having a lot of opportunity to recycle ideas that are working into things that are still cheap. You know, I'm seeing a lot of that in the UK. I mean, Harvey's finding that in the cyclical space, particularly in the US. So.
I think as well, this will perhaps be controversial, but it has to be relative. And I think we're in an environment now where the returns on most asset classes are likely to be very low over the next 10 or 20 years. So, when I started the Australian fund and we were sitting here saying, 15% returns were achievable based on the opportunity set that was in front of us, I think that is almost impossible now and very dangerous to actually go chasing those sorts of returns. I think we've got very good prospects of, 7 to 10 from the current portfolios that we've put together. And I think in this world, that will be a very attractive return relative to other asset classes. There's a quick one from Keith. What, if any, are the benefits to you, the Forager team, from these webinars?
My mum gets to watch it.
Engagement with investors.
Yeah, actually, we do get questions that help you stress test theses from some point at some point in time. But the main aim of this is to give you an insight into how we're running the portfolios and what the opportunities are that are out there. And I think particularly at the moment, we've done a lot of it over the past year. I think it's important that we keep hearing from you and you keep hearing from us when we went through a period of poor performance. And I think as we sit here now with the portfolios that we have, and things have been going a bit better over the past 5 or 6 months, we just want to make sure that you're aware of that with your investment as well, and that you understand what the underlying portfolios look like and what's driving those returns.
I also wouldn't discount the benefits of being forced to simplify an investment case to present on something like this. We do it through the quarterlies as well, but laying the case down in a simple fashion, it helps to clarify your thinking.
Bernard had an interesting one.
Gareth, this is probably worth touching on after events over the past few days, but how's the thesis on Blanco Technologies playing out? This stock is more than 10% of the international portfolio, which is the largest weighting we've ever had. So maybe worth a quick summary of what's been happening there.
Look, we've been pretty quiet on it lately, partly because we've been increasingly confident of the investment case and that the stock was too cheap. The flip side of that is that if the stock did rally, we were going to want to sell some for portfolio management reasons because it was becoming too big a part of the portfolio. We don't want to be accused of pumping and dumping. So we didn't want to be out spreading the story and then selling into it. Things are lining up really well there. I've got an unpublished blog ready to go, and it will probably be part of the December quarterly. The acquisitions that they made in July on the mobile side of the business look really, really important to us. It was the mobile side of the business was the bit that I had the lowest conviction in when we bought this stock 2 years ago. It has moved up the ranks in that terms. There's a lot of growth here that is, I don't want to say guaranteed, but highly likely. We're increasingly comfortable with management, strategy, and the tailwinds behind the business.
Yeah, that stock, I think the news flow has been very good for most of the past year in terms of results and distribution deals and things that they've been announcing, and the price had hardly moved. And over the past couple of days, I think it was actually the UK equivalent of a shares magazine or something wrote a write-up on the stock, and the price was up quite a bit on retail buying there, and it also seemed to encourage some fairly significant volume into the stock, potentially on the institutional side.
I think there was a handful of institutions trying to buy, and it was probably the trigger for them to pay up a little bit. So the stock's moved up 20-something% in the last few days. So it's doing well. Yes, it's certainly my highest conviction position, and from a team perspective, also our highest conviction stock.
Just a general question on new cars, and maybe a couple of different thoughts on this, but are we not at a tipping point in regard to investing in new cars? People waiting for EVs, people retaining ownership until EVs come onto the market at a reasonable cost by companies such as VW. Therefore, does that not affect some of the investments in the auto sector? Jeffrey, you got any thoughts on that one?
Yeah, sure. So maybe in terms of new cars, maybe in terms of how it relates to our investment in car sales, I guess they are primarily exposed to used cars, so people looking for second-hand cars. In terms of the risks, in terms of the long-term shift to EVs and an autonomous fleet, I do see that as one of the key long-term risks to car sales. That's hopefully something that we can monitor and watch the news out of the US, seeing what's happening with the key players, with Waymo and the other developments in the US, to try and get a sense of, I guess, how that is developing. Yeah, I agree it's a risk that needs to be monitored.
Yeah, I've been a little bit surprised how robust the second-hand market for cars has been. I think if this theme was playing out that everyone was just hanging on to them, you'd maybe see less of that in terms of turnover in the second-hand market as well. But I do think it's something to watch closely.
I think it's an incremental thing rather than a abrupt shift. And you're already seeing it. I'm most familiar with the UK numbers, not so much Australian, but that car park, the fleet of cars in the UK is just getting larger and larger and older and older. So you are seeing some of that already, and we are dealing with some of that already. I don't know if there's a step change beyond that, or whether it'll just be a gradual process.
I think that's right. There's obviously multiple factors acting on this at the same time, and one of those is probably the longer term structural, and in my opinion, the much more significant one is this shorter term cyclical component.
We've got a few questions here on the traded price of FOR and the discount that it's currently trading at. Some people questioning what we're going to do about it. Other people asking about the communication, how we explain what the product is about. It's something that we've talked a lot about internally over the past year, and certainly something that we're conscious of. I think at the moment, we don't see any reason to change the strategy that we came to market with. We think there are a number of things that are important to a transparent and liquid market: size, communication to the market, performance being a very important one, and that's the one where we've let people down over the past 12 months. So, my view of things, and you guys can speak up if you've got any other ideas on this, but the first thing for us to fix here is the performance. This is a trust where we pay out that performance as distributions over time, so people will get the return in the form of distributions. But at the moment, that is the primary focus rather than any other mechanisms here.
Absolutely. And we've been talking, as well as the performance angle, about the type of stocks that we're usually invested in. So on the Aussie side, despite some more liquid recent additions, it's a reasonably illiquid portfolio, and that closed-end pool really helps to be able to invest in those sort of stocks.
And what about the wider space? Are you guys looking at listed investment companies as a potential investment for the fund, or there's been a lot of criticism and talk about the space in the media? You have thoughts on the general landscape out there?
We've had a look around, and obviously there's been some news around on this topic. For the majority of these, the liquidity for us is quite low, and the opportunities on offer are not as substantial as in some of our other operating businesses.
Jeffrey, a question on Smart Group. What were your thoughts on the insider sell down and CEO retirement at SIQ?
Yeah, look, so for the CEO retirement, I guess that was something we always saw as a risk, given he took long service leave for 3 months last year, and also he sold a big chunk of stock. So I guess it was something that we did see as something potentially coming. In terms of, I guess, how it changes our view on the company remains a very difficult to dislodge administrative service provider in the salary packaging space. And it's performed very resiliently despite 19 months of continuous decline in new car sales. We think eventually the new car sales will turn around at some point. And also, I guess in the long term, we do have that tailwind from employment growth in health and charity sectors. So we think the investment case there still stacks up, and the multiple is attractive. Probably 14.8 times on NPAT-A. So it's still an attractive investment. Maybe the risk of losing that capital discipline, which you had from Devon, who had a great track record and was very focused in his capital allocation. The risk of losing that discipline might be heightened. But in general, we still think it's an attractive opportunity.
Yeah, definitely disappointed in the way that was managed, though. We had the company had a significant shareholder sell down their investment in the business in a large block trade, and then it was a matter of weeks later, I think, that the CEO announced their resignation. It would have been much better if those things all happened together, but largely we think that things are still in place there, and we've got a chairman with $20 million or so invested in the stock that'll be pretty focused on capital allocation as well. A really good question about being fully invested up here. What do you do if a great opportunity comes along, you're fully invested, and this idea of cash as a weapon to take advantage of disruption in the market? What are your thoughts on that, Gareth?
Well, I'm probably more of a person that's comfortable holding cash, but we as an organisation have made the commitment to be mostly invested most of the time. And I think there are a lot of advantages of it. It's a Darwinian process to see what gets into the portfolio. And we've had to do some selling of things specifically to make, on the international side, to make room for the stocks that Paul and Harvey have recommended.
Yep. Harvey?
Yeah, it's just constantly testing the thesis and updating it. Things change every 6 months. So the notion that you picked something 3 years ago and everything's still, the exact same is very unlikely. So I think it's about having some sort of fair valuation target price. Stocks worked really well. Maybe it's time to take some off the table from the position, whatever else. And I think we seem to be doing this every couple of weeks, having a debate of, what do we still like there? What is maybe ripe for trimming to make room for new things? So again, healthy debate. Plus, what is your goal here from when you made the investment to where it is today?
Yeah, I think in both funds we're very conscious of the liquidity implications of what we are doing. So, we're not going to 100% invested in a portfolio full of very illiquid stocks, particularly on the international side. We've got things in there that we've added over the past 6 months that we're perfectly happy to sell and can sell instantaneously to add better value opportunities to the portfolio. And you should expect us to build up a even longer list of those types of businesses over the next few years. I really like the idea of having a really good bench of stocks that we know very well. We've done our research on. They're good quality businesses with lots of liquidity that we're happy to own. And instead of that experience of the past few years of things work out well on a number of stocks, we sell them, we go to 30% cash, and then we spend the next 12 months trying to put that cash to work. I think it's cost us a lot of money in terms of returns, but I also think it's put a huge amount of pressure on around finding those ideas and maybe more risk taking in some situations than we should have taken. So I feel like, as the CIO, that ability to say, okay, we're selling this stock that's worked out really well. We're putting the money into something that we know is a good business and is liquid, and we're able to sell it later, but we also think it's an attractive investment over a long period of time as well. We're setting the portfolios up to do that rather than we're 100% invested in highly illiquid stocks across the board.
I would dare guess that we can sell 40% of the portfolio overnight without much impact, given some of the positions we're in. So,
and there's another 40% that will take quite a long time.
Yes, exactly.
There's a really good question. Which stock do you disagree about the most? I'll start with the Australian fund. So put them on the spot.
I'd say some of the weightings is probably where we disagree the most on certain stocks. A lot of them, we're sort of coming at from a similar angle on a particular opportunity. Sometimes the analyst who brings that idea might want to size that a little bit lower or a bit higher, and in the end it would go into a portfolio at a slightly different weighting.
Come on, no politician here. Give us an example.
Am I saying, should we say this? No.
I mean, I've been an advocate for trying to reduce the in-era weighting in the last little while, a little bit more than we have. And we have done that to some extent already, so I'm feeling a little bit more comfortable at the current weighting.
Yeah, look, I agree with Alex. I think the weighting is probably the key question. I don't disagree that there are probably very good opportunities in the portfolio. Maybe just to call out two, probably Thorn Group and MRM are the ones which are pretty high risk and are very large weightings. So, yeah.
Good. And on the international side, what would you say you two disagree the most on?
Just Group for me, I think. It's not so much a direct disagreement as I still don't feel I grasp it.
He stole the words right out of my mouth, but I think we have.
So the short of it is everyone hates my ideas.
I think we've gotten rid of some of the things that when I came in, I had questions on, where we were in the cycle, some of the oil names and so forth. And I'm really glad to see those kind of out, because it's just so hard to figure out what's going to happen there. So apart from that, the other sector, which I just don't understand very well, is financials. We got rid of Ubi, which is great, and it's just a sector I don't play in. So because I don't play in it, and I look at other spaces, it's something for me that, again, grasping and really understanding the thesis and case behind it is just it's a decent leap. So.
It's good. I think the debate in the office has been very healthy with a growing team, and particularly having everyone back in Australia sitting around the one table. I think even the cross-pollination across funds and jurisdictions and what's happening in the US and Europe, and how does that impact some of the businesses potentially down the track here in Australia, or even the other way. You know, I think we do have some businesses here in Australia that are a bit ahead of the curve in terms of what's happening globally, and watching the growth of Afterpay here, and now it transplants to the US. And whether it's Afterpay or not, what does that mean for credit card companies long term that have had this dominant mode for a very long period of time? I think those questions and debates have been very healthy.
I've got a question in there about Matrix that might be a good one to.
Yeah, I mean, Harvey just touched on oil and gas. A lot of questions, or a couple of questions here about the overall exposure to that. I think it's fair to say in the international fund, we are now back to almost a couple of tiny little positions in stocks in that portfolio, but we still do have quite a bit of exposure in the Australian fund.
So we've got a couple. MRM, which is an owner of the offshore vessels, is one of those. You'll see a little bit on it in our monthly report. Environment seems to be improving there. Another is Matrix, and it's sort of, there's been a couple of questions around it. It fits a little bit now more into our get a little bit more involved in the business. So you would have noticed that they've sold, and one of the questioners pointed this out, one of their land and buildings and on a sale and lease back in WA. That's freed up about $20 million for the company. We've been an advocate, and we've taken this view to the board of paying some of that cash back to shareholders, because we think the business itself has a thing that they do quite well in the oil and gas space. Further expansion out of that doesn't make as much sense for us and hasn't historically been successful. So we'll continue to be on, continue to go to the board with this idea and continue pushing for some of the capital back there.
Yeah, and we're going to want to see more of that in the Australian fund. The recovery in terms of profitability and outlook here has been much slower than it has ever been before out of a downturn, and slower than we anticipated. And largely that's not because demand is a problem globally. Demand has been marching up every year, but there has been lots of supply coming in, particularly from US shale. And I think also as well, it's an environment now of a lack of capital coming into the space. Nobody wants to invest there. It's probably, I saw a statistic the other day, Harvey, that you sent around, that Apple is now worth more than the whole US energy sector listed on the American Stock Exchange. So it's a fairly extraordinary statistic that one company is worth more than a whole sector. So, and I think that capital for some of these businesses that we own, we actually need capital coming in, new projects being developed, and lots of money going into it. So it's been slow and long. We've seen a lot of balance sheet repair at those businesses and some signs of things getting better, but we also need some really sensible capital allocation decisions to be made there. How are we going for time, Alex? One more question, maybe?
Yeah, one or two.
Do the Motorpoint trade.
There was one on Zebra and 5G, which...
Well, maybe 5G in general for you, Harvey, because it's a theme that you've been doing a lot of reading and work on.
Well, you know, I'm still doing the reading, so don't want the cat out of the bag. But, you know, there's the first derivative play of buying the telecom equipment providers, you know, the Ericssons of the world, and that's done. Rollout's happening. But I think that there's this whole second and third derivative play that people maybe aren't quite thinking about pricing the stocks, whether it's testing companies that are testing these 5G technologies and products that are being developed that are going to use 5G technologies. You know, Zebra's a good example. There's a question up here from someone that, will it be displaced by IoT, particularly in the 5G world? Actually, it's quite the opposite. There's going to be a big refresh cycle for their products as 5G rolls out. 3G is being phased out in the US, for example. And there's still a number of kind of terminals and so forth that are connected to 3G. So that's going to be done by 2020, 2021. And, you know, 5G is the next step. They are a huge beneficiary of IoT. If you think about what they do, you know, they have automatic data capture and identification, which needs to be sent over to the central database and then analyzed immediately, right? So actually, IoT is part of the secular growth drivers behind, you know, Zebra sales and performance. So it's actually quite the opposite.
Okay, and one last one then. There's been a lot of questions up there about Thorn. Maybe a quick discussion about what's been happening there over the past 6 months and some of the changes we've seen.
So there has been a lot of change at Thorn over the last little while. We've had new board members come in, 3 of them. We've had a CEO that's changed. New CEO is due to come into the business in February. We've had the company settle a class action that's been outstanding for a very long time. And we've had a capital raise there to allow them to settle actually that cash drain from the class action. So all of that has been very distracting. All of that has been something that we've looked at and spoken to the company in depth on quite a few of those matters. From now on, we need to see a plan from the business, and part of that will be the new board with the new CEO as to what's happening there. Throughout this process, they obviously got a bid for their equipment finance business that was made public. The company didn't end up taking that opportunity. But there is also the radio rentals consumer leasing business that's sitting there at the moment earning substantially lower returns on the capital that's employed there than it should be earning. It'll be up to the new board and the new CEO to unlock that potential.
Yeah, it's a situation where there has been a lot happening behind the scenes. I think if you're an owner of the stock, you're probably not going to see that turn up in sensational results over the next 6 months. It's probably 2 to 3 years that it's going to take to turn this business around. Having said that, there's a lot of costs to come out in the short term, and our understanding is a lot of changes that have already been made on the cost front that should mean this business is profitable in the second half of the year and into the next year. But in terms of it being worth what we think it should be worth, which is multiples of the current price, there's a lot of work to be done there. And we still think some big strategic decisions to be made about what businesses this company should actually be in and where the capital should be allocated. Well, that's it for us today. We'd like to thank you for tuning in and your attendance. Please let us know what you think about the video format and anything else we've discussed today. If we haven't answered your question up there, then we will try to get back to you via email over the next couple of days. Thanks again.